Good afternoon and welcome to the April 2025 edition of the NDSU uh, Egg Market Situation Outlook webinar. My name is Dave Ripplinger, Economic Specialist with NDSU Extension and regular host. This is officially back to our regular webinar. We've been doing this for about 5 years, targeting farmers, ranchers, agribusiness leaders, and others who want to know more about the current and expected market conditions and their impact on North Dakota's economy. This webinar is being recorded and will be archived on the NDSU Extension YouTube channel and the web page for the webinar series. Just so you know, you will be muted throughout the webinar, but you're very much encouraged to ask questions using the Q&A or chat function. We'll answer those at the end of the presentation, but feel free to ask those at any time or as they come up if we're going through that process. If by chance you have any technical issues, feel free to reach out to me using the chat, and I'll do my best to help you out. With that, I'll turn it over to Brian Parman.
I thought for today's or this month's webinar, I was going to cover something that's been discussed in the news lately, especially the last week or so, and that's talking about tariffs and the potential impact on federal debt, deficits, interest rates, and that kind of thing. Sort of how that dynamic works, why it matters, and maybe some expectations going forward as far as that goes. So the first thing I want to hit on is just talking about the federal debt real quick. And I know that's a often a coffee table conversation that people have at home or with coworkers or whatever, but just to kind of lay out where things are at as far as that goes. So this is from the 2024 fiscal year report from the Department of the Treasury. This chart is, and this just shows the last 5 years, 5 fiscal years of the federal deficit. So obviously the difference between a debt and a deficit is the amount, in this case, yearly, by which the U.S. government takes in less than it actually spends. Okay, so every year, if you're running a deficit, you're taking in less money than your expenditures are, and obviously that adds up to over time. But you can see right here, and this would be in billions of dollars. So it's effectively, if there's a comma here, trillions. So for instance, 2024, last fiscal year, the budget deficit was, just under about $600 billion or so. There's been years, for instance, 2022, it was nearly $1 trillion in the deficit. So in other words, that deficit gets converted over into the debt, all right, after the year concludes. So what do we spend the money on? This is coming from the same report, and these are broad categories of federal government expenditures. You see Department of Agriculture, 3% here, Department of the Treasury, 3%, Veterans Affairs, 6%. The big consumers of federal spending, Department of Health and Human Services, 23%, Social Security, 21%. Defense spending 17%, and then actually 12% of the federal spending goes to service the debt. So 12%, so not insignificant there. And as I said before, a deficit is the yearly shortfall of spending versus revenues. And then here's the federal debt, which as of the 31st of March 2025 was around $36 trillion. Okay. And this changes by the second. So by the time I put this on there, I was already too low. So I just tried to put a date on there, and you can really see the last 15 years or so, that nominal debt number really gaining steam. I mean, this looks like an exponential growth model, which it basically is that federal debt keeps increasing because we keep running yearly deficits. So we're all pretty much aware of that, or at least have heard about the federal debt and the deficits. But one of the other questions is, who holds the debt? Who owns U.S. debt? All right, who's buying up these debts? Because there's not a bank out there. Well, there is a bank, the Federal Reserve, that the U.S. can borrow from, but it borrows by and large most of its money from governments and individual people like myself or anyone else on this webinar. But I've heard it said in the past, well, foreign governments own, all this U.S. debt or a tremendous share. This chart on the left from the Treasury Department So as of December 2024, foreign entities held about 24% of the US debt. Okay, so that'd be the kind of the light pink version under here. So then the rest, the remainder, okay, so 76% was held by uh, domestic holders. Those would be mutual funds, individuals buying treasuries, the Federal Reserve, et cetera, et cetera. So that the vast majority, over three-quarters, is held domestically. But of the foreign countries that own U.S. debt, who owns the most, you might ask? Well, as of April of 2024, Japan was the largest holder of U.S. debt at just over $1 trillion. Okay, so of the 24% of foreign-owned debt, Japan has just over a trillion. China is just under $800 billion dollars as of 2024. The UK comes in third, just over 600 billion. I was a little surprised to see Luxembourg in fourth, but it's almost $400 billion dollars, and then Canada. So those are the biggest foreign holders. The rest of the world actually holds far more debt than any of these countries individually, but they just happen to be the largest holders of U.S. debt as far as a foreign country goes. So here's the concerns related to tariffs as it pertains to this debt and deficit that the US government is pretty much perpetually, annually, and monthly running, is that it kind of the theory goes like this. Excuse me. Tariffs can reduce imports, right? If we make imports more expensive, we get fewer imports coming in. That's kind of the point in some ways of tariffs is it protects domestic businesses. And it's not only a tax that raises revenue for the federal government, but protects domestic businesses because then imports are reduced and you get more domestic production. And imports are purchased with dollars. Okay, so when something comes into the country and it's imported, we buy it with dollars. Now, a large percentage of the dollars paid for those imports are funneled back to the U.S. and what's called capital investments. Okay, that could be investments in businesses. We've got foreign-owned businesses in the U.S. like Nissan and who builds cars in Mississippi, and Yokohama Tires also has a plant there, and Toyota has plants, as well as purchasing U.S. government securities and as well as private securities, stock markets and things like that. So a reduction in foreign investment, okay, puts more pressure on domestic investors to basically make up the shortfall. So if there's a reduction, for instance, in the purchase of U.S. treasuries by these foreign countries, okay, no one foreign country makes up a huge sum, but taken all together, it's nearly a quarter of them. There's not as many entities there to buy up this perpetual government debt that keeps coming. And so then it puts it on domestic investors to buy it up. And if a demand isn't as strong with domestic buyers, bond prices have to fall, like treasuries, and I'm talking like, well, any bonds really, but treasuries as well, must fall to get them sold. And so yields, interest rates go up. When bond prices fall, the yield goes up, right? And in the short term, tariffs can raise domestic prices. That's another concern as far as inflation and interest rates go. That as we're trying to build the infrastructure and potential manufacturing to produce the stuff that we're now tariffing coming in, before we can get that stuff up and running, at least in the short run, we can expect prices to go up because of as a result of the tariffs. And that can impact then inflationary expectations. Uh, for the fact that people expect prices to go up, then you couple that with potential bond weakness, okay, weakness prices in bonds, and as a result, interest rates go up because bonds are sold as people wait for rates to go up. It becomes somewhat of a self-fulfilling prophecy. And like what actually happened a day or so, a couple of days ago, a bond sell-off causes bond prices to fall, making yields go up, increasing interest rates. So as I promised Dave, because I know he wanted to see it, I'm showing a portion of what's called the ISLM model from macroeconomics. So those of you who've had macro, um, yeah, this is a nightmare probably for you. But this just illustrates how the whole thing works. Okay, so you got the supply of loanable money. That's this black line here that I'm highlighting. And you have demand for money. That would be businesses, companies, individuals wanting to borrow money. All right. And In the absence, if the federal government isn't in play and if the federal government isn't borrowing money or anything like that, then the interest rate is right here, this R1 number. All right, so now insert the US federal government borrowing money, and the supply of money doesn't change. It stays where it was before. Now the interest rate has to go up. Okay, so demand for money shifts to the right, interest rate goes to R2, we have a higher interest rate. But if the supply of money then also increases because of foreign investment, right? Like I said, 24% coming in and buying up some of this debt and investing in the United States. Well, then the supply of money increases. This causes a rightward shift and the interest rate drops from R2 to R3. Okay, there you go. All the macro you ever wanted to know and a lot of it that you didn't. But that's effectively how it works theoretically. And one of the reasons we really focus heavily on the 10-year Treasury as a benchmark is simply because of how closely the 30-year mortgage rate, which is the benchmark interest rate, follows the 10-year Treasury. I mean, the red line here is the 10-year Treasury, the blue line is the 30-year mortgage rate, and when you look at them, they are highly correlated. Okay, highly, highly correlated. And there's a lot of reasons for that, and I don't want to spend a ton of time going into it, but a lot of it has to do with how tied they are to investment and alternative investments and risk-free rates and things like that. But if there's weakness in the 10-year treasury market to the point that we're having trouble getting them sold or people are dumping them and it drives that rate up, it's going to drive the 30-year mortgage rate up no matter what the Fed does. Even if they drop the federal funds rate, if something like this happens, it can increase the interest rate and they're moving opposite directions. So, has that happened? There was a big fear a day and a half ago that that's what was going on because we saw bond prices spike. Well, and I'm sure others on this webinar are going to mention it, but President Trump, he basically delayed the implementation of the heftier reciprocal tariffs for basically 90 days on all countries, basically except for China. And anyone can correct me where I'm wrong there, to basically move it back down to that baseline 10% and give 90 days for these entities, the EU, whoever else, Japan, et cetera, to negotiate a deal so that to avoid these tariffs going on. Okay. And what that basically did, all of a sudden, everybody showed up. There was a huge bond auction yesterday by the federal $39 billion in 10-year notes were sold. And demand was really strong at that auction, essentially saying that, okay, there isn't a big bond sell-off going on right now. People are still, the demand for bonds is strong, and we're not in danger of a big bond sell-off and interest rates spiking quickly. And that's good news as far as interest rates go. There was a big expectation again yesterday that that wasn't going to happen, but it did happen, and as a result, so far okay. And now had the 90-day extension on, or basically 90-day reprieve from those tariffs not happened, I don't know. I don't know what the result would have been. It would be purely speculative if I even guessed. But the 90-day delay happened, and as a result, folks are still bonds tend to be in high demand as a hedge against volatility in the markets and other things like that. But one thing it has done the last week or so is the expectations for a rate drop have weakened. All right, so the top one is the June expectations for the federal funds rate based on market expectations, and I want to show you a month ago, so the 10th of March, about 9.5% of market participants thought the Fed would not drop rates in June. A day ago, that number's moved up to 27%, thinking that the Fed will not drop rates in June. And you go back, and now about the majority, 60%, think if there is a drop, it's going to be 0.25% is all. Very few in the market think it'll be more than 0.25%, if any. And here's for the September federal funds rate. And you look here and you can see, all right, a month ago, only 1.6% of people thought that there would be no change in the federal funds rate by September. That number's moved up a little bit to 3.5, but you look at the people who think there will only be a quarter point, that went from 13 to 20, and people who think that there will be a half a point, and moved from 34 to 40. In other words, when you look at expectations, folks are starting to move towards, slowly but surely, the fact that some of the what's going on in the macro economy related to tariffs and bonds and everything else, that the Federal Reserve may not drop rates in the next quarter or 2 quarters even. That's the way the sentiment's starting to move. Me personally, I don't think that there will be. I don't think there will be a rate cut in June. Uh, I'm on the fence about September. That September is a long time away, and there's a lot of trade negotiations that have to go on between now and then. So that would be awfully speculative for me to talk about September right now. But that's just what the market is thinking. So with that, I know that's a lot of macro crammed into a 15-minute talk, but I just wanted to illustrate sort of the theory and the thinking behind why some of these policies can impact things like interest rates directly right out of the gate. Indirect would be expectations of prices and those things, but directly is the ability for the government to sell bonds and domestic investors to be able to buy those bonds. And that's just what I wanted to show here. So something to think about as we move forward. So if there are any questions, I'll be on at the end to answer them as best I can. If I don't know, obviously I'll say I don't know. Let me stop sharing my screen. Back out of here and turn it over to Dr. Frayne Olson, who I'm sure has excellent news for all of us.
Well, I hope so. So good afternoon. Frayne Olson, crop economist, marketing specialist with NDSU Extension. As always, here's my contact information. If I would prefer that you ask the questions today, if we can try and get them answered. If you do think of something or have some questions later on, feel free to contact me. Probably cell phone and or email would be the most likely, most reliable. So a couple things. We're going to be talking about the WASDE report. So this morning at 11 o'clock Central Time, USDA updated their monthly forecasts for production and consumption of both the U.S. as well as global grain supplies. They do also quite a bit on meat and meat inventories. So from what I saw, the report was, I would consider it neutral for soybeans, slightly positive for corn, and slightly negative for wheat. I'll go through the specific numbers here in just a moment, but I just wanted to give you kind of a heads up. I will be talking about the U.S. trade and trade policy. It continues to evolve, and I put the parens rapidly because there's literally some announcements that came out this morning that I'll try and update you on. And again, as we go through for the next several months, we're going to be talking a lot about negotiations. I'm sure there'll be some questions and critique about agriculture and how agriculture plays a role in these negotiations. I do want to emphasize and remind everybody, agriculture is an important component of trade negotiations. Many of the countries that we interact with get to be very protective of their agriculture because they don't want to become too dependent upon another country for their food supply. So agriculture is often a very contentious or an area where there ends up to be a lot of disagreements and disputes. However, it's really not, from the US's perspective, the primary driving focus. The reason we've gotten into these trade negotiations, the reason for all of the tariffs and proposed tariffs is not because we have this big problem within agriculture. But so agriculture is a big component of this, but it's not the only thing. There's a lot of other complicated things that go on behind the scenes. So I just want to remind everybody and put that in context. So very quick, a couple updates. Late yesterday, President Trump announced that he was going to suspend the reciprocal tariffs. Now, I want to be really, really clear and careful here. So the tariffs that he suspended for 90 days, so they're still kind of on the shelf. They just said, okay, we're going to take a pause here. Those were the tariffs that he announced on the 2nd. So about a week ago, President Trump announced this large, long list of countries that were going to be included and again, trying to target what he considered to be the most egregious offenders. So those were the ones that were suspended. Okay, but the base reciprocal tariff. So if you remember right, there was a 10% tariff put on every country or every product coming into the US. Okay. Now that new additional 10% that came on, that is still there. So this base 10% rate was not changed. The pause was on the additional for those countries that got tagged for additional tariffs, those above the 10%. That's what's been on pause. So to be very clear, and President Trump was very clear about this, this does not include China. So the tariffs and the issues with China are separate from the way he's dealing with all of the other countries. So those US tariffs on Chinese products that were recently increased to 125%. I mean, as of this announcement, they were increased to 125%. And then later on this morning, there was a clarification said, look, this 125% is on top of the original 20% that was put on in, I think it was late January, first part of February, due to the fentanyl crisis. So right now, every product from China coming into the United States has a 145% tariff on it. Okay, so the real number, the effective rate is 145. So we got to, I mean, everybody's trying to make that very, very clear. The pause also did not include the Canadian-Mexican tariffs that were put in place because of the fentanyl and immigration issues as well. So the issues with Canada, Mexico, which were not included in these reciprocal tariffs, are therefore not included in this 90-day pause. So the trade issues, the trade negotiations, all the stuff going on with Canada, Mexico, that essentially has not changed at all. The other thing that was very specific is that this 90-day pause does not include the tariffs that have been put on steel, aluminum, and then the additional automobile tariffs. So this pause, even when it first came out, people got very, very excited. It's like, oh, we got some time. But then as we got more details, as we got more of the information, it's still a big relief. At least we have time for a lot of our major trading partners to be able to come to the table and see if we can't work something out. It's still a major announcement, but it's not probably as advantageous as a lot of people were really hoping. Specifically because of China. All right, so this morning, this announcement was yesterday, and we came out with some clarifications this morning. But then also this morning, the European Union announced that they would pause their proposals for an additional 25% on selected U.S. products. So if this would not have happened, if the pause would not have happened, the EU was scheduled in a couple weeks to put an additional 25% onto U.S. corn, wheat, barley, rice, poultry, fruit, wood, motorcycles, clothing, and dental floss. I don't know why they added dental floss, but that apparently made it on the list. So those special tariffs now, those retaliatory tariffs that the EU is going to pose on U.S. products have also been paused for 90 days. So again, what we're trying to do is take a breath to see if to give the U.S. Trade Representative's Office some time to be able to review the proposals that are coming in from other countries, to sit down and have those negotiations on the trade front to see if we can come up with some kind of agreement that will be more advantageous, hopefully, for both parties. Okay. Now, I do want to back up in time a little bit, a couple days. So on the 8th, a couple days ago, China, just as to follow through now, China imposed an additional 84% tariff on all U.S. products they import. And that was up from 34. So if you remember the discussion we had during our webinar last week, I talked about the additional 34% that China had put on. Now that 34% has been scratched and they moved it to 84%. So the tensions and this tit for tat strategy the negotiating, or at least the verbal jousting that's going on right now between the United States and China is continuing. That is very challenging. It will be challenging for the U.S. soybean exports. Now, fortunately, like I remind everybody, at this time of the year, right now today, we as the United States usually don't export a lot of U.S. soybeans. Right now is kind of our slow period. Our really peak selling time period and delivery time period is right after, kind of at harvest and right after harvest. So from about September, October, into about the first part of January. That is really our peak sales period and our peak delivery period. By the time we get into spring's work, and in particular into planting and the growing season, almost the whole world, China and almost everybody else, has shifted all of their buying into the Brazilian market. And so right now, we as the United States really don't sell a lot of beans at this time period. And that's one of the reasons we haven't seen I guess what I would expect to see, a much more of a negative price response from the grain market. So when it comes to dealing with China, I think in my assessment, the futures market and the futures market traders, as well as the cash market, is kind of having a wait and see attitude. They're really, I think, crossing fingers and toes that we're going to have some kind of an agreement between the United States and China before we get into our harvest here in the United States. So we do have several months. Again, I'm knocking on wood that will all take place. So let's very quickly go into the report we got today. As I have done in the past, the blue row on top here, that's highlighted in the blue, that is what the trade was expecting to see. Again, there's a survey of the market traders and analysts that's done usually about a week or so before these reports were released, just to give us an idea of, what do the traders really think is going to happen. And then we have the highest trade estimate, the lowest trade estimate within that survey. We look at last month's numbers, and on the very bottom is the numbers we got today. And what I usually suggest is, from a price response standpoint, thinking about what happened in the markets, we usually compare the blue row on top with the red row on the bottom. So we were expecting to see a slight increase in ending stocks for wheat. We got a little bit bigger increase than expected. And that's really a combination of two pieces. Not that the bottom line number changed a lot, but again, it's enough psychologically to make a difference. USDA did increase wheat imports just a small amount, and they decreased wheat exports a small amount. So they made some adjustments on these trade flows. For corn, if you notice that they were expecting a slight decrease in corn, and we got a little bit larger decrease than expected. Now, the adjustments that were made, we had a small decrease in feed, the forecast for total feed consumption, but we did get an increase in USDA's forecast for corn exports, which, is a little bit surprising to me, but, they ran their models, they run the math, they're right now expecting a slight uptick in total export sales. And I think some of that, I want to be very careful, some of that I think is a carryover from, we've had more aggressive corn exports than what USDA was first forecasting. So some of this might be just a catch-up thing. And then finally, for soybeans, when we compare, basically the expectations were unchanged. We did get a very small reduction in ending stocks, which is a little bit favorable, but I would say basically a push. There was a small increase in imports, a very small increase a decrease in imports and an increase in crush. And so with those different little adjustments, we came up with a slight reduction in our ending stock. So that's why I said it was slightly negative for for wheat, slightly positive for corn, and about neutral for soybeans. When we look at, did USDA adjust or change their estimation or expectations for the size of the South American corn and soybean crop? The short answer is no. They've been holding pretty firm, pretty steady with their estimates, for both corn and soybeans out of Brazil and Argentina. So nothing new news there. Last couple slides, this is as of, I captured these, this is for the futures market now, futures market prices going back. I drew in those blue lines. The black line that bounces around is the daily futures price. I did want to give you a kind of an update on, let's make sure that we all understand what's happening. This is for all like the old crop corn number. I pulled this chart at about 12:30 today. So you can see that, we've had a downtick when all this tariff and trade things first started appearing. We did get a downward movement, a downward pressure in corn prices. Not nearly as far as what we had during that basically harvest period. When we look at that October time frame, was we're in the middle of harvest. So we did get a retracement, but now in the last several days, we're starting to rebuild as some of these trade tensions start to relax a little bit. So again, from a corn standpoint, a little bit of a surprise here that the corn market hasn't been more pessimistic about the trade and tariff issues that we're seeing right now. So I just want to remind everybody, yes, we've seen a downturn, but this has not been the falling off a cliff like a lot of people I think were expecting. Looking at soybeans, we've had a little bit more damage in the soybean futures market, but again, we haven't gotten down to those lows that we saw back here in mid-December, basically just before the holiday season. We had a real rapid drop off with a slight recovery. We have had some downward pressure on soybeans. Again, this is the May soybean futures, but now because of some of this kind of stabilization in our trading policies, we've seen more of that trading range begin to reappear here. So again, there's been some price damage in soybeans, but not nearly as bad as I think people had first expected. Now, that's not to say we don't have the potential for more downward pressure. I want to emphasize that. However, this really hasn't been as bad as I thought it would be, to be very blunt. For spring wheat, again, spring wheat has had its challenges over the last several months. Again, because of this trade and tariffs, the wheat market tends to be very sensitive to trade. There's a lot of both buyers and sellers in the global wheat market. And so the recovery in the last couple of days, again, with some more optimism about what's happening with trade with our other trading partners. China, we don't send a lot of wheat to China, but a lot of our other trading partners are obviously covered by some of these reciprocal tariffs that have been placed. So just wanted to give everybody an update saying, yeah, it's not great out there, but it's been a lot worse. So with that, I will stop sharing and hand things over to Tim Petrie.
Good afternoon, everybody. Tim Petrie, Extension Livestock Marketing Economist. Just talk about some of the price impacts of tariffs, and won't spend a lot of time on it because we did last time, and Frayne covered the new situation quite well. Just kind of to show you how volatile things are, we had an extension conference yesterday, and so we were at meetings, so I wasn't watching very closely what was happening and the news and so on. So this is just on that green line down here to the left is what happened Tuesday, and we'd already went well from the very, very high on feeder cattle to the very, very low. We'd went down about $20, but it came back and maybe we're $15 lower or so. But then, in Tuesday there, we were plugging along there on May futures about 271. And I guess closed around 271.50 or whatever. So when the market opened up yesterday morning, it was wild. It opened up $1 lower down there at 270. Then it doesn't even show up on this chart. These are 15-minute intervals. So it opened at 8, within 15 minutes, it opened at 270 and went down to 267. And then within that 15 minutes, it climbed back up to 272. And so really, really volatile at the start, not knowing that Trump was going to do anything or whatever, but just shows you the volatility and there are a lot of investment funds in the market, and some start bailing or some start buying. It causes a lot of volatility. So throughout the day then, and I was checking my cell phone once in a while when I got a chance at the meetings or whatever, and pretty benign trading there about 273. But like Frayne said, when the announcement came up, wham, I looked and all of a sudden there at lunchtime, we're eating lunch. I looked and, we're up about $3. What in the world happened? And then I kept looking, 3, 4, up to $5 higher. And so that's how the market responds when that announcement came out. And now today, again, like Frayne said, that, okay, the tariffs are off for 90 days, all well and good, but now reality setting in and there are still some tariffs and some concerns and so on. So just basically showing you how quick the auction market, or how quick the futures market can change. And even at an auction market, people are saying sometimes, we're plugging along there and with a market so and so, and then all of a sudden in an hour, how can things change? How can cattle go up $3 or down? And the answer is because everybody's on their cell phone like I was and seeing the futures and so on. So just the other thing, kind of look at the overall impact of since the original tariffs were enacted and so on livestock. And then I'm going to get off the tariff and go to some more current events. But, start with April and then also then, excuse me, how the cash market has responded compared to the futures market. So on fed cattle from the very, very high, not necessarily closes now, from the very high to the very low, came down about $13. But on the cash market over this time, about a $2 decline, which may have happened seasonally anyway. So, the cash market was not impacted very much, but the futures market was, and that affects feeder cattle into those distant futures of fed cattle where feedlots would hedge into. So the futures market is important. But in the case of fed cattle, the futures went down a lot, but the cash didn't. Go over on the right-hand side to feeder cattle. The April didn't respond downward as much with the tariff announcements because the cash market stayed high. In fact, the cash market only went down. This is the cash settlement price that the futures settle on, which is all the auction markets from North Dakota down through Texas, and one daily price added up for $7 to $8.99 weight cattle. But anyway, it only went down about $1.50. But some of the later feeder cattle futures contracts went down from the very, very high to the very, very low, about $20. So there was a big impact on the futures. Still didn't show up in the cash market. And remember, again, those tariffs were not going to go on till now, at least some of them. So a lot more impact in the futures market, which again, when we're looking at the price volatility here, that happens a lot when we're at record high levels, which we still are in the cash market. We can be very volatile, and things can affect the market for things to change in a hurry. Go down to the bottom left, hogs again. The futures has had a big reaction. About 30% of our pork, about 12% of our beef is exported, but over 30% of our pork is exported, and China's important market in Mexico and so on. So big decline there, also $11, I guess, on the futures from high to low, but the cash market was under pressure, and the April futures were higher back in February than the cash market is to begin with, but the cash market down about $4, I guess. So anyway, then over on milk again, class 3 milk has crashed. Over on the fluid milk side, we don't export any milk, but from the class 3 there, we do export a lot of non-fat dry milk, a lot of cheese, a lot of whey, and so they have all crashed as well because of the tariff announcement. So like I said in our tariff webinar here a week ago or so, we are the largest exporter of beef and pork, and second only in chicken, and so on and so on. So the export market is very important. Okay, let's come back to reality, forget tariffs, and look at some of the current events and things happening. So I've received several calls from lenders saying, that I've got some producers that want to borrow some money for summer grazing, and with record high prices, they need quite a bit of money, and I'm wanting to know more about that. And so I've told them, and telling you that for both producers and for lenders, that we do have a summer grazing budget on our website, showing up there above. Just Google NDSU livestock tools or whatever. And so I'm not going to go through all these numbers and so on, but just hit a couple of high points and go down here. I just put in 365 50 weight cattle. But if you follow the auction market, just a week ago or so summary at markets in the same geographic location, there's a range in prices from 335 to 284 a hundredweight. So you start putting 384 cattle in versus 370, 60, 50, whatever, that makes a big difference as well. But I just took the average of 360 and put that in. And then I put 282 in there for a selling price. That's what the futures closed at yesterday. I'll just show you that in a minute. Well, let's just go to it now. There's September feeder cattle futures, and yesterday closed at 282.30, and we have about a par basis for 850-pound steers. So that's the projected price. And so it gives you, still with, even though we have record high prices and so on, and again, everybody's costs are different. So that's up to the, the individual, but, just on the average and looking at some, there's probably still some money in summer grazing, and there usually is, to encourage that. What I do have circled up here is, I think price risk management should definitely be considered because of the, 90 days, what's going to happen in the meantime and everything else. So if you put on price risk management right now, maybe you don't buy the cattle for another month, and the closer you go out, the lower the premiums are going to be. But there was an $80 premium there on LRP last night up until 8:30 this morning. So I'm not going to go through all this again. If I lose somebody if you don't understand LRP, I can give you more education on that later. But anyway, yesterday that 282.94 a contract would cost $9.65. So again, 965 a hundredweight times 50-pound, 8.5 hundredweight steer is $82 there. So the other thing when we're looking up here then is between the producer and the lender, and how much risk and how much cattle do you want to have and so on. But I know $82 seems like a lot of money per head there. And so is there some way you could reduce that? So again, this spreadsheet, this budget shows you what your break-even price is, which is down about 271.45. So you could go down on an LRP contract to 271.63 there, get your break-even price at 602. That's $51 for that contract. So save 31 save $31 there if you would put that here into your spreadsheet. So again, summer grazing looks possible. The big thing we're worried about, obviously, and I'll show you the drought monitor in a little while, is it's dry out there. Is there, for some, there probably isn't going to be enough forage, and you're going to try to keep the as many of the cows as we can together, simply because calf prices are so high. So that's another consideration, so on. But just mainly showing you that this spreadsheet is available. So just go back to the what the market is doing. And again, I've talked to you this many times. So there's the red line and fed cattle, and we're up there at record high levels. A little bit different on the futures then. The gold futures are what the 2025 futures were pre-tariff. And now the red bars are yesterday's closing price. And so you see that we have taken the futures market down a little bit, depending on what contract it is or whatever. But, approximately, the $12 or so or whatever across the board there. Still, however, if those red futures, even what they were yesterday, hold true, still better prices than last year, or record high prices, which is supporting feeder cattle. But again, we're watching a lot of things, consumer demand and what's going to happen with tariffs and so on. So go to calf prices again, like I said, they're at record high levels, about 360, but some wide range up to 384, down to 335 or whatever. But they would be kind of following that similar pattern of fed cattle of higher levels this year, and unless some catastrophic event comes along, then switch to the heavier weight yearlings again. At pretty much record high prices here the last several weeks, and the same thing there. There's yes, the futures market was higher pre-tariff back there, and has backed off now. Originally $20, but did come back up and came up $5 last yesterday too. And these red bars are yesterday's close, so they came back up close to where they were before, but are still down, but again above what they were last year. And again, summer grazing program, looking into September prices or whatever, that's why there's maybe still some money there. And I've been mentioning lamb prices here quite often here. It's the big holiday demand now. Right prior, you're getting closer to the holidays and Easter and so on. And so lamb prices have held just similar to where they were last year. And I think expectations could be to follow a similar pattern to last year. Now, the other thing I just want to finish up talking about is here's the drought monitor that just came out today. And again, I mentioned, in Western North Dakota, probably less interested in summer grazing because of how dry it is out there, but just want to make you aware that is quite a bit, actually 5 counties there from Dunn County and McKenzie and Williams and Montreal and so on up there in North Dakota, at least, are in D3 extreme drought, and are just had a meeting with our weather person. And if it doesn't rain out there as spring gets here, then since the ground is thawed out and so on, there maybe could even be some expansion there. But on April 15th, just next week, is when the livestock forage disaster program kicks in. And so again, for the quite a bit of Western North Dakota is in D2, and if you're from another state, you can see that. So in order to get a payment for D2, we have to have 8 consecutive weeks starting with April 15th in order to get a payment. However, for these D3 counties, the 5 of them, if by next week on the 15th are still, and the way it looks now, they likely will be and could even be expanded, you're already would be eligible for 3 payments. Now, as of yesterday, the USDA hasn't even issued what those monthly payments would be. Last year, I think when they put out their monthly payments, that's the total monthly payment that they predict. But then from then on, they pay 60% on that, and then take another 5.7% off for some previous farm bill called reconciliation and so on. So for instance, last year, I think we started off with about a little over a $52 was their monthly payment. But when you boil that down with the deductions, take 40%, 45.7% off, it amounted to right around $29 to $30. It will be lower this year, I know, because it's based on the price of corn. The last year or the last 2 years, depending on which one has the higher price, but corn has been going down and is lower. So that payment will be lower this year, but just calling your attention to the fact that, that we may be eligible for payments as soon as next week. And we do have a spreadsheet on our website there, again, under the same one as the budget, where we will put, it's not updated. This is the 2024 calculator, but when we get the new information in a week or so, we will Ron Haugen, and we will update that so that you can make estimates of what your payment might be. And you'd have, a long time. You have until March of the next year to completely apply. And so since you're just eligible this week, most producers don't apply right away, although they are eligible to apply to wait and see if it gets drier and whatever, because, if it goes to D4 or D3, those payments might increase. So with that, I will stop sharing and turn it over to Dave.
Yeah, so a few things this week, kind of stepping a bit away from tariffs or specifically looking at tariffs. One of the interesting things that's happening in the market that might not be getting full attention is what's happening in energy. And so looking at the West Texas Intermediate spot price, so the U.S. North American benchmark for oil, has seen a pretty precipitous decline in price over the last month or so for a variety of reasons. Among those was, even before the tariff situation fully escalated, there was questions about domestic demand based on the economy, and then there was also signals from Saudi Arabia that they were going to begin increasing production. In part, at the time, that might have been because of a weak economy to have those lower prices. And of course, there's two sides to lower prices. On the consumer side, that lower price might be good. On the business side, the production side, it's not the same type of news. I purposely went back a few years for WTI. It's similar to why Frayne had corn more than just recently, just to see when the last time we kind of touched these prices was. And for WTI, it's been a few years, back to 2023. You really can't exactly compare, for example, rig count, again, because we're in this a kind of volatile stage. And back in 2023, we were really recovering from the depths of COVID. Looking at some data from the Dallas Fed, this is operating costs that were reported by oil companies in March, by formation. So you can see across that, for North Dakota, we're really in the other U.S. shale. But years ago, they did have a North Dakota Bakken price. So this would be if the well has been operating, what price do you need to keep it going or to not shut it in temporarily? And it's about $45, a level that we really haven't been close to reaching. It gets a little bit more interesting when we talk about the price needed to complete a well in different formations. And here, if we look at those formations and we look at that other shale again, we're looking at $66, a price that we have been significantly below at times this week. And so we're really at an interesting point in terms of where these prices are and what type of activity we could expect. There's also, considerable interest thoughts, steel, with the steel tariff, what that might mean to the economics of continued development for any particular well. This chart shows a few different things. So oil price and rig count, which is really kind of the bigger takeaway or bigger interest. And again, we've saw that decline. We can't really map things back. Right now, we're at about 30 rigs. We've had a slight reduction the last week or so. Is that noise or is that something bigger? We really can't tell. Really looking forward is kind of the question. And then also from the North Dakota standpoint, oil tax revenues are significant, and the impact that oil has hits tax revenues in a variety of different ways. And typically we think about royalties or production related things, but it's also the sales tax, the amount of economic activity required to maintain, even 35 rigs is quite significant, generates considerable state sales tax. Next thing I want to talk about just a little bit is a recent development regarding a rather unique, or at least from the past, a rather surprising coalition that's come about. Up until about 2017, 2018, there was a rather adversarial relationship between the petroleum, fossil fuel industry and biofuels that in many respects has disappeared or has certainly declined. And great evidence of this is a recent agreement between the bigger portion of the fossil fuel of the petroleum industry and agriculture and the biofuel industry. And that, in this case, particularly relates to agreement in what number should be set for the renewable fuel standard. So I'll walk through a few things, but kind of a refresher reminder of some of the main mechanics and why this is important. So again, the renewable fuel standard is federal policy, mandates biofuel use by different type and by year. They do this by setting renewable volume obligations each year. And so that is actually the specific amount. By law and regulation, those are supposed to be set the previous year for the subsequent year. What's really happened is they've kind of gone in clumps. And oftentimes the actual RVOs aren't even set until we've entered a year or maybe even past a year. And then finally, really brief coverage of RINs. So RINs are renewable identification numbers. Those are tradable permits that allow some flexibility or market driven forces to balance out supply and demand in terms of who's producing, who's importing, who's using this biofuel. And that price ends up being kind of a proxy for what that opportunity cost is of blending using that next gallon of biofuel. The actual numbers that were put forward, and again, it's kind of a broad coalition in terms of agriculture and the biofuel industry, and then on the fossil fuel side, it's the American Petroleum Institute, which is representative, the major refiners, the major players on the petroleum side. And again, the number that they've put forward for 2025 is 5.25 billion gallons, which is a substantial increase from what that's for 2026. These are each a year off. So we're talking about, almost 2 billion more gallons of the mandated use in this space. And again, that's a substantial difference. What's interesting is this is pretty close to where the market was operating. So if you look at the chart, so that's biodiesel and renewable diesel stacked. This is probably one of the few times in my life I haven't deleted the grid lines, because here it is quite helpful. So that 5 billion number, or that 5 billion line, we can see that we've been over that for much of 2024. And again, the market's ability to produce that isn't really in question. And in fact, our ability to use it really isn't in question. And so this general agreement by petroleum folks, ag, and the biofuel industry to say, hey, let's set the number here for 2026 going forward. This is really interesting and important, again, because it does set that bar at a reasonable level. Also, too, if you look at how RVOs are supposed to be set, they were always intended to be set at what could be supplied, not really what could be used, because supply, as long as it was available, the RFS was supposed to require, encourage that pull on the other side. So it's like if the market could make X many gallons, that's what the RVO generally was supposed to be set at. And for the last few years, especially for biomass-based diesel, that really hasn't been the case. Some interesting impacts in this. It's certainly going to support biomass-based diesel use, which is coming at a good time given uncertainty with 45Z, the production credit for clean fuels. It's also broadly good news indirectly. So, of course, this supports the use of biomass-based diesel, consequently the production, consequently those feedstocks with soybean oil particularly, but also canola oil. But one of the things that happens because of how the RFS works, because we're going to raise the bar for those biomass-based diesel RINs, those will now be used or have to be applied for that RVO instead of flowing over and being extra surplus in other markets. And so we certainly, I don't expect to be in the case where we're going to have that policy demand pull for corn ethanol, but we're not going to have this abundance of RINs in the market, which again drive down prices. So those were my prepared remarks. That ends the presentation section. As you may have known, we did have a special tariff edition last week. Right now, we are planning to have one again in about 2 weeks. We'll definitely let everyone know about that. Right now, our next regularly scheduled webinar is on Thursday, May 15th, but we'll likely have something between now and then. With the presentations being completed, we can open it up to questions. I don't see any, but I actually have one for Frame. Put you on the spot. And that is this is regarding to WASD and how they put together the numbers of what they have to consider. So we have this volatility in how we're setting tariffs, from hour to hour. How does the World Egg Outlook Board incorporate that into their estimates?
That's a great question. It's probably something I should have covered. So literally this morning, as I printed off the report, started digging through the numbers, the very first thing on the front page at the very top highlighted, and I'll read this to you, the WASD report only considers trade policies that are in effect at the time of publication. Further, unless a formal end date is specified, the report also assumes that these policies remain in place. Okay, so when they're doing their forecasts, when they're running their models, they look at the trade policy at that time. And just understand the actual mathematical running of these models is done about a week ahead of the publication, because it takes them about a week plus to be able to run all the models, get all the tables put together, have everything reviewed one more time before it's officially published. So, this was the April 10th edition, so I'm sure the models were run approximately the very beginning of April. And so I don't know if the implication that I'm having from this is that the reciprocal tariffs were not in place, because the reciprocal tariffs were not supposed to be, they were announced on the 2nd, April 2nd, but they were not supposed to become effective until later. So it's my impression in reading that and understanding the timeline that I don't think the April edition included any of these major new announcements, but I do think it included the tariff issues with Canada and Mexico.
Oh, one other thing I wanted to add, I know Frayne was talking pretty specifically about how reciprocal tariffs for many of those countries were removed, everybody except China, basically, but the 10% baseline remained. The other thing that remained is steel and aluminum tariffs. Those
Yes,
are not, Frayne didn't bring that up, and neither did I, but those tariffs are not removed either.
No,
Those
I
are,
did
I'm sorry.
note that. I did note that. But
I'm
yeah,
sorry if I
yep.
missed it.
No, that's okay.
But that's important to remember. And like I was talking about with those bond markets, as soon as uh, President Trump announced the 90-day reprieve on reciprocal tariffs on basically everybody except China, that's when the bond market really shifted, right? I mean, almost instantaneous. So, one thing I want people to recognize is what we say today. And if somebody watches this recording in a week, if new announcements are made, um, a lot of this, I guess we got to put a disclaimer on that time stamp on some of this, because it really matters that much that it was the delay for negotiations was made, and bond markets reacted almost instantaneously.
Yep.
And I'm sure it's going the same way with commodities and futures as well. And it makes it challenging for not just prediction but planning, and we understand that.
Yeah, one thing it also does, so talking to some faculty teaching, during this time, this is evidence of how well our markets operate when that information is available. There's that immediate reaction, and if the information is heavily weighted one way or different than where the market's at, it will move.
Mhm.
And it's always fun when you actually get to live that, in front of students. And this is probably the best week ever for that. Question I have for Frayne, we don't have any others. If people are definitely still welcome to ask. When do folks book corn sales and soybean sales? Is China in a regular year, would they be looking to the fall and picking up the phone, or is that something that would come later?
So typically for China specifically, well, let's break it down by commodity. For soybeans, that is the one that we have a very distinctive pattern, and it repeats itself almost, every year. And that's not just Chinese purchases, but it's also purchases of our other major soybean buyers. And again, those purchases really begin the kind of the pricing of that usually begins in earnest in September, just before harvest begins, so that they can plan up and get the delivery system up and running, and it peaks in about, let's say late November, early part of December, and then by the time we get into mid-February, mid-January and first part of February, things are dropping off and kind of slow. It's got a long tail to it. So that one is very distinct and repeats itself pretty carefully, pretty predictably. For wheat and corn, we don't have as strong an export sales pattern. It tends to be a little bit more uniform throughout the year. We do see a little bit of a surge and increase right around harvest and shortly after harvest. China is for wheat. China is just a very sporadic buyer. They typically are kind of, one year they're in pretty heavily, and the next year they don't buy anything. Now for corn, it's kind of the same thing. The United States is the largest corn producer in the world, and China's number two. Now China is not quite self-sufficient in corn, so they do have to import some. A lot of that does come from Brazil. But Brazil, if you remember right, has two corn crops. They've got one crop that they're just now finishing harvesting, and there's one crop that they just finished planting. So the ability for Brazil to supply China on more of a regular basis is a little bit easier. This year so far, China has bought almost no corn from the United States. So is there going to be a seasonal pattern? If China does buy U.S. corn, it's typically just after that harvest time window. Again, when supplies are very adequate, when the supply chain is running very fluidly, it's a little easier for them to step in, make some purchases, get some quick deliveries, kind of basically to backfill some of their supply chains from Brazil. So the China issue is really strongly a soybean play, not as much for wheat and corn.
Thanks, Frayne. I think with that, we'll wrap it up for, I won't say for this month, I'll say for this day. And please stay tuned to see a likely notice of another special trade and tariff seminar in a couple of weeks. But we do definitely have a regularly scheduled one on May 15th. With that, I want to thank all the presenters and everybody who joined us today. Hopefully things are smooth for the next few weeks.